Federal Reserve just told you exactly what they're thinking. And almost everyone missed it because the biggest signal wasn't what they added. It was what they quietly removed. Yes, they held rates in the 3.50% to 3.75% range. Yes, that was expected. Yes, the market had priced in no change. But buried inside the statement was a missing sentence, and that absence is a louder message than any headline rate decision. When the Fed deletes language, they're not being casual. They're editing the future, one line at a time. Here's the missing piece, the phrasing about a shift in the balance of risks. In prior statements, that line worked like a pressure valve. It signaled sensitivity to downside growth risks and left the door open for more easing if conditions deteriorated. Now it's gone, which means the Fed is no longer telling you that risk has tilted decisively in either direction. They're not warning about overheating. They're not bracing for a rollover. They will be replanning themselves in what Powell effectively described as a comfortable zone. And that is the real policy decision. Extended pause, policy inertia, wait and watch is the base case. And that matters enormously for precious metals. Because gold and silver don't just trade on rates. They trade on expectations, on real yields, on the credibility of the dollar. And on the question nobody wants to ask out loud, what happens when the world realizes that stable policy can still mean steadily eroding purchasing power? It is Thursday, January 29th, 2026. And today we were going to dissect what the Fed said, what they refused to say, why one dissenting vote changes the political geometry of monetary policy, and how you navigate a market where Citi is calling for $150 silver, while Bank of America is warning that silver is the most bubble-like asset in the entire system. Those two things can be true at the same time, and if you don't understand how, you'll end up reacting to price instead of understanding it. So let's slow down and read the statement like investigators, not like headline scanners. The Fed held the funds rate steady after 3 consecutive rate cuts last year, cuts that pushed borrowing costs to their lowest level since 2022. The hold itself was not the surprise. The surprise was the shift in tone. They upgraded their description of economic activity, calling growth solid instead of moderate. That one word is a tell. It's the Fed saying, we don't see urgency. At the same time, they acknowledged job gains have remained low and that unemployment is showing signs of stabilization. In plain English, the Fed is looking at a world that is neither breaking nor overheating, what economists love to call Goldilocks. And when the Fed believes the economy is just right, the instinct is not to act. It's to sit still and let time do the work. Now here's why the deletion matters more than the hold. In the old language, the Fed was essentially admitting uncertainty about growth risks and keeping the market psychologically prepared for more easing. In the new language, they're withdrawing that emotional support. They're telling you, policy is appropriate. Powell reinforced it in his press conference, repeatedly framing last year's cuts as sufficient accommodation to support both inflation and growth objectives. Translation, we did our job, now we wait for evidence. And in markets, we wait is not neutral. It changes the entire probability tree for assets priced off future liquidity. This is where precious metals get complicated, in a way most commentary refuses to acknowledge. A steady Fed can support gold and silver by keeping real rates from spiking higher, keeping the opportunity cost of holding non-yielding assets manageable. But a steady Fed can also remove a short-term tailwind if traders had been positioned for additional cuts. When the Fed signals an extended pause, some of the most aggressive front-run-the-easing positioning gets vulnerable to unwinds. And that's where corrections are born, not because the long-term story died, but because the short-term crowd got too confident. Before we go further, do me a quick favor. If you're getting value out of this kind of mechanics first breakdown, hit like and subscribe. It takes 1 second. It tells the algorithm to push this to more people who want the real framework instead of the noise. And it keeps you plugged into the next update when this situation evolves fast. Now, there is another layer to this story that turns a routine Fed hold into a political signal flare. Governor Waller S. Dissent. Waller voted for a 25 basis point cut instead of holding steady. On its own, that's notable, but the context is what makes it electric. Waller is widely viewed as being on President Trump's shortlist for the next Fed chair. And when a potential future chair leans dovish while the current chair holds firm, markets don't just read it as one opinion. They read it as a preview of a possible regime shift after the leadership transition. I'm not telling you Waller's vote was politically motivated. I'm telling you perception becomes pricing. Investors, traders, and institutions price the direction of the next regime before the first decision is ever announced. That's why independence matters as a market variable, not just a civics lesson. We've discussed the growing public tension around Fed independence, the narrative pressure around Powell, the broader push and pull between political incentives and monetary restraint. Waller's Dissent drops a new piece onto that chessboard. Right now, 2 rate cuts are priced in for later in 2026. While the near-term path is expected to be flat through this quarter and potentially until Powell AS term ends in May. So the Fed is telling you inertia now, but the dissent is whispering uncertainty later. And uncertainty is fuel for hard assets, because the more the market doubts the stability of policy, the more it questions the stability of real returns on cash and bonds. Let me ask you directly. Do you think political pressure is influencing monetary policy in 2026, or do you think that concern is exaggerated? Drop your take below, because the answer to that question shapes the next decade more than a single quarter-point move ever will. Now let AS deal with the piece that makes this entire setup so bullish for precious metals over time, even if it's messy in the short term. The Fed and its tolerance for inflation above target. Powell was explicit that much of the overshoot is being driven by tariffs rather than a domestic demand spiral. He suggested drawing a line between inflation that has a one-time level shift and inflation that becomes self-reinforcing. And that framing is everything, because it gives the Fed a permission structure to look through hotter prints without panicking hawkish. Think about what that means. If core inflation, excluding tariff-affected categories, is sitting just above 2%, but total core is closer to 3%, once you include tariff impacts, the Fed can say, we see it, but we didn't treat it as the kind of inflation that requires immediate tightening. In other words, they can tolerate elevated inflation as long as it's not morphing into a wage price spiral. That takes one major bearish catalyst off the table for gold and silver, the surprise hawkish pivot triggered by a hot headline number. And if the Fed is willing to let inflation run somewhat above target for longer, the long-term implication is brutally simple. Real returns on cash and many fixed income instruments struggle to keep pace. Purchasing power erodes quietly. The dollar can be stable in nominal terms and still be bleeding in real terms. That's the environment where hard assets don't need hype to work. They just need time. But time is not the only force at work right now. Momentum is. And that brings us to silver, because silver is no longer moving like a commodity. It's moving like a stress test. Silver surged about 60% in January alone. Say it out loud and let it feel absurd, because that kind of move compresses years of price discovery into weeks. It crossed $100 for the first time last week, then kept ripping, printing fresh records, and even touched around 117.71 or on January 26th with a massive intraday surge, one of the biggest single-session gains since 2008. That inks it's not normal. That's not healthy. But it's also not random. Citi analysts raised forecasts toward $150 within roughly 3 months and framed silver as gold squared, driven by Chinese demand, tight supply, and expanding industrial use across solar, EVs, and data centers. They're essentially saying the market needs higher prices to force metal out of strong hands. They even point to the gold to silver ratio. If it mean reverts toward the 2011 low near 32:1, you get scenarios that spit out numbers like $170 silver. That's the kind of math that used to live in internet forums. Now it's in institutional notes. And yet, here is the contradiction that people can de-emotionally hold at the same time. Bank of America ranked silver as the #1 bubble-like asset dynamic across the entire landscape. Above gold, above crypto, above everything they measured. HSBC added caution, basically asking whether it's time to sell the family silver, arguing silver hasn't magically become a new safe haven. It's more likely a catch-up move that turned into momentum, with retail pouring in as industrial demand also accelerates. So you have institutions pulling the same chart in opposite directions. One side sees structural repricing, the other sees a blow-off. This is where professionals separate themselves from gamblers. Both can be partially true. A real bull market can also experience speculative excess. Fundamentals can justify higher prices over time, while price action outruns reality in the short term. The question isn't who's right. The question is, what happens first? Continuation or mean reversion? And that's why the Fed's missing sentence matters. When policy is inert, momentum can run farther before it hits a break until it hits one hard. Now let's add the dimension most Western investors underestimate: China. China is one of the world's biggest suppliers of refined silver, and it began enforcing new restrictions on exports this year. If you restrict exports, you don't just tighten supply. You change the geography of availability. You create regional scarcity, different premiums, different delivery timelines, and different definitions of what the real price even is. If China is trying to keep silver inside its borders to protect domestic industry from rising input costs, that's rational from their point of view, but it's a supply shock for everyone else. And here's what makes it more than a niche policy story. Silver is no longer just a monetary metal narrative. It's an industrial bottleneck narrative. Solar demand has surged. Photovoltaics have become a massive portion of industrial silver consumption compared to a decade ago. EVs require silver for electrical systems, and next-gen battery technologies threaten to pull even more. Data centers are exploding, and silver's conductivity makes it embedded in the hardware stack that powers modern computing. defense applications, electronics, grid infrastructure. This is the metal that quietly sits inside the systems the modern world cannot run without. That industrial bid creates something like a structural floor under the long-term trend. Even if speculative buyers get shaken out, industrial users still have to source metal to keep production moving. That's why silver corrections can be violent but short-lived when physical conditions remain tight. The market can punish late momentum buyers without actually breaking the underlying thesis. So how do you position in a world where the Fed is signaling comfortable pause? Inflation is tolerated because it framed as tariff-driven silver is both an institutional bull case and an institutional bubble warning, and China may be tightening supply. You start by respecting uncertainty. Anyone claiming certainty here is selling you an emotion, not a framework. The plausible outcome range is wide. Silver could surge toward $150 on continuation, or it could correct 30% to 40% on a momentum unwind without invalidating the long-term story. Both are realistic in an environment this stretched. Here's the deep question I want you to sit with, and I want you to answer it in the comments because it reveals how you actually think about risk. If silver dropped hard tomorrow, would you interpret it as proof the thesis was wrong, or proof the market is shaking out weak hands before the next leg? In other words, do you view volatility as information or as a threat? Your answer changes how you behave when the chart starts moving like an earthquake. Also, tell me this. Are you in silver primarily for the investment thesis, monetary credibility, real yields, currency erosion, or for the industrial thesis, supply constraints, and non-negotiable demand? Which one do you think is stronger in 2026? Because the most dangerous mistake right now is fighting the market with a single story when the reality is multi-causal. And this brings us back to the Fed, because the Fed is trying to freeze the narrative. By removing the balance of risks language, they're telling markets, stop expecting rescue, stop expecting panic, stop expecting quick pivots. But markets don't stop moving because a committee wants calm. Markets move when imbalances build, and imbalances are exactly what you get when inflation is tolerated, policy is inert, and essential industrial inputs tighten globally. So let S build the practical framework, the way to think when the noise is loud and the outcomes are wide. First, separate the trend from the pace. The trend in precious metals has been up, driven by real forces, policy uncertainty, inflation tolerance, supply issues, and a growing industrial base. The pace, however, has been extreme. A 60% monthly surge in silver is not a stable equilibrium. That kind of acceleration invites profit-taking, liquidation cascades, and emotional reversals. A correction does not automatically mean the bull market is over. Often it means the market is repairing itself. Second, size for volatility. This is the part nobody wants to hear because it's not exciting, but it's the difference between surviving and blowing up. If a brutal drawdown would wreck you financially or mentally, your position is too large for the instrument you're trading. The goal is not to be the hero at the top. The goal is to stay solvent and rational while the market tests everyone's discipline. Third, plan for multiple scenarios before the move happens. Ask yourself, with a straight face, what you will do if silver spikes toward $150 quickly. Will you trim? Will you hold? Will you get greedy? Then ask what you will do if silver snaps back toward the psychological 100 zone, or even below it in a fast momentum unwind. Will you panic? Will you add? Will you freeze? If you don't decide in advance, the market will decide for you in the moment, and the market S decisions are usually designed to punish emotion. Fourth, watch the physical signals that don't care about your chart. Premiums, availability, regional dislocations, and the real-world constraints that reveal whether the move is merely speculative or also structural. Because if physical tightness persists, it doesn't guarantee price goes straight up, but it does change the character of corrections. It means dips can become opportunities rather than endpoints, depending on your time horizon and risk tolerance. Now zoom out to the big picture, because this is the part most people miss while they argue about the next candle. The Fed is telling you policy inertia is the base case. They're comfortable with rates where they are. They're comfortable letting growth run. They're comfortable tolerating inflation that's somewhat elevated, as long as it's framed as tariff-driven rather than demand-driven. In other words, the Fed is sitting still while the world stays unstable. And that is the kind of backdrop that can keep hard assets supported, even as they experience sharp resets along the way. So what breaks the equilibrium first? It probably won't be the Fed, because the Fed just told you they want to be the last mover, not the first. The pressure will come from elsewhere. Labor market deterioration that forces easing and inflation reacceleration outside tariffs, that forces tightening, a geopolitical escalation, that drives safe haven flows, a trade de-escalation that cools fear premiums, or a liquidity event that forces leveraged players to dump what they cannot, what they want. That's why the missing sentence is huge. It's the Fed quietly telling you, we're not here to validate your expectations. And when the central bank refuses to validate expectations, the market becomes more sensitive to shocks. In that environment, your edge is not prediction. Your edge is preparation. Your edge is understanding that a metal can be structurally bullish and tactically overextended at the same time, and that discipline is how you benefit from the long term without getting destroyed by the short term. So I don't leave you with this. We are living through a rare period where decade-level moves are happening in months. That doesn't mean it will continue in a straight line. It means the system is repricing something fundamental: trust, scarcity, and the real cost of stability. If you want to thrive here, you don't need perfect forecasts. You need a framework that survives turbulence. Tell me in the comments what the Fed AS missing language signals to you. Does it make you more bullish because it implies inflation tolerance and policy inertia, or more cautious because it suggests less easing ahead? I read every comment, and your perspectives help shape what we investigate next. And as always, this is educational, not financial advice. Think for yourself, do your own research, stay calm, stay curious, and I'll see you in the next one.